This is chapter 20, video 1. Let's launch. All right, so in this video, we're going to swap from corporate operations and corporate financial accounting and all that other stuff. We're going to come back home to where I kind of play a lot more, and that's going to be describing the tax aspects of flow-through entities, whether they're tax partnership or S corps. This is probably, when I talk about doing corporate tax returns and business tax returns, this is what we do the most. Partnerships, S corps, things of that nature. Really excited about doing this stuff because there's a wide variety of things that that you get involved in. If you like company operations, but you also like individual operations, this is a good way to be able to do a little bit of both. And if you take a look at it from that perspective, there's different types of pass-throughs, and here's kind of the funny thing about this. Prior to 2017, nobody really cared to define too much of what a pass-through was. And usually when you thought of pass-throughs, it's partnerships, S corps. But as the 2017 rules got passed, as sole proprietors started qualifying for a few things that these flow-throughs qualify for, we bring them in. And in some cases, trusts do qualify as a pass-through. Basically what happens is with trusts is that you can actually do it to where there's two ways you can do it. You can have it where the trust actually pays all of the tax at the trust level, which is usually not the smartest move because usually trusts still max out at around $13,000 of income. Or you can go ahead and you can have it to where the actual beneficiaries who are going to receive the income will end up picking it up in taxes. And in that case, they'll get a trust K1, or if it's a grantor trust, they may get a grantor letter that'll basically say, hey, these are the items of the trust. These are the items that we picked up. Why they do grantor letters versus just doing a K1, I don't know. I don't know if it's just, like a bunch of lawyers got in the room and said, hey, things are a little too simple on the trust side. Let's make things more complicated. And we'll do grantor letters for some and K1s for others. I don't know. I don't know why it's a letter versus that. But I do know, like I said, I do actually do a lot of grantor trusts because in foreign tax, grantor trusts are generally seen as the defaults for how the U.S. is going to treat certain trusts that actually exist in the foreign realm. And so that's when we see that. But again, you have your partnerships. I didn't do chapter 15 in this class. That was actually kind of a group decision that we did. But and I think some of that also stems from the fact that if you took business law, which obviously you have, if you've gotten to this point, you've already talked about what a general partnership is, limited liability, LLC and LLP and all that sort of stuff and others. So it's not really that important, but those do qualify as flow-throughs if they retain their flow-through tax status and do not elect to be taxed as an association or a corporation. So overall tax rate, it's basically going to be taxed at the marginal rate of the individual. Top rate is going to be 37%. Now, some of y'all might say, wait a minute, if I got a C corporation that does 21%, but I could go as high as 37%. Why would I even consider not doing a C corporation? And there's a lot of actual tax aspects of that. Remember, you got double taxation. That double taxation effectively takes that 21%. Say I take $1 million and it comes from the partnership, and I split it off into two people. So it's $500,000 to this person, $500,000 to that person, and we'll say that they're both married filing joint with no other income in that bracket. According to my book right here, you're going to be taxed at the 35%. Okay. And that's what's going to happen here, assuming that's, with the partnership income and all that sort of stuff. Now, if I take that same income in the corporate world and I have a 15% tax rate for the dividend sent to you, and I have a 21% tax rate of the corporate income itself, you add those together, it's 36%. So that is one reason why, from an income tax perspective, in that case, it would still make sense to be a partnership. Now, there's a few aspects why it wouldn't, because you still have self-employment tax. But the best part about it is once it's taxed, you don't have to worry about a tax ever again. And so that ends up being the case. Something you're going to know, though, if you do this often enough, partnerships are generally not seen as the best vehicle for doing most business operations. Usually if we have a client and the client comes to me and they say, look, there's 3 of us, we're going to do this sort of thing. They're making $100,000 or more per person. We're probably going to start considering the election to go from partnership to S Corp and moving them over to an S corporation at that point. But that's talk for another video. But for the most part, that'll get them out of the self-employment tax. They can pay themselves a salary and they can get that. But anyways, that's kind of the thing. Normally partnerships are really good for passive type stuff. So if you want to do an investment partnership, or if you want to do, a rental real estate partnership, those are generally going to be the good businesses to be using a partnership. So the owners of the entities, our tax of the partnerships are passed through from them to their own tax return. And then, there could be, an employment tax of, 3.8 to 15.3%. Generally speaking, if we're at more than 100,000, like I said, we're going to be looking at S Corp elections. So, you're not, but why does it go from 15.3 down to 3.8? Here's why, because, generally speaking, once you hit the certain benchmark at the Social Security wage, whatever that Social Security wage number is, you're no longer taxed on that additional income. As the income goes up, you're not taxed additional rates at Social Security tax, but it goes down towards, the Medicare tax rate, which is 2.9%, but you can add that 0.9% additional Medicare tax. That gets you down to the 3.8%. And so that's going to be kind of key. Flow-through income is taxed at the individual's rate. We've already talked about that. On the S corporation, shareholders are not subject to self-employment tax or additional Medicare tax on their business income allocations. Stop for a minute. Okay, I want you to focus on this for a second. As a partnership, if I have a partnership and it makes $1 million and I have 4 business owners, it goes down $250,000 to each owner. They're going to pay self-employment tax on it. If they're an S corporation, $250,000 are going to show up on their business tax return. They're not going to pay self-employment tax on it. But one thing that they're going to have to do as an S corporation, you must pay yourself as an employee of an S corporation. That is actually a mandate out of the IRS. And if you don't do it with the IRS and you start making a whole bunch of money, eventually they're going to come to you and say, look, you're not doing this right. We're going to fine you and you need to start paying payroll to yourself. Okay, so that's going to be very, very key in determining all of this stuff. Ownership compensation, again, sole proprietorships, no compensation. The way it looks at is that as a flow-through entity for a Schedule C, if it makes $100,000, you have rights to that $100,000. You've been taxed on it already. You can take and do whatever it is you want with it. S and C corporations, you will pay yourselves a wage, and you have to pay yourselves a wage. And how much do you have to pay? Technically, according to the rules, it's fair market value of whatever it is that you do. However, from a practical standpoint, if I do fair market, like right now, I own Beta Solutions. I do probably about, I don't know, somewhere between $50,000 to $100,000 worth of work to Beta Solutions. If Beta Solutions doesn't make $50,000 to $100,000, the IRS isn't going to come back to you and say, you have to do this. Okay. It's a facts and circumstances type thing. And they're going to examine things. They're going to look at it again. Like for example, if Beta Solutions is making $500,000 a year and I refuse to pay myself a salary, they're going to come after me for it. And as a result of that, that's something that I have to be very careful about. And so that's why as an S corporation, we're constantly evaluating, am I paying the owners enough, blah, 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 so on and so forth. In this way, you pay wages. They're subject to FICA, and that's how they get the Social Security tax out of you. It is deductible by the entity. It is not eligible for QBI deduction, and the wages are not eligible for QBI deduction, but the business income that comes from the S corporation is, which is another reason why owners have an incentive not to pay themselves wages, which is one of the other reasons why IRS tends to aggressively chase after this. Owners of entities taxed as partnerships, you've got guaranteed payments, self-employment income. If you do guaranteed payments, what happens is that you do guaranteed payments, it'll show up as box 4 on your K1. And so what'll happen is, say, for example, the partnership makes $1 million. Out of that $1 million, it pays both of its, and we'll say there's 4 owners. We'll say all 3 owners are going to get paid $100,000 a piece. So they're going to get a deduction of $100,000 times 4, 400,000 from that million. So the partnership is going to report $600,000 of income. Divide that by 4, 150 grand a piece. Each of the owners is going to have a box 4 adjustment, box 4 entry for $100,000. When they file their tax return, they're paying Social Security tax and Medicare tax on that $100,000 as though it was wages. But instead of having to file payroll tax returns in order to get that stuff done, it shows up as guaranteed payments. So as a result of that, that's just kind of how this ends up working out. Again, guaranteed payments are not eligible for the QBID. All right. So income flow earned by flow-through entities, not taxed at the entity level. Owners of flow-through entities are taxed at the entity share of the income allocated to them. In other words, when you file a partnership tax return, you don't pay any tax on the partnership tax return. The deliverable on the partnership tax return is not a tax. It's an information statement. It's basically an information return. And that K1 then gets sent down to the owners. The owners then go ahead and they say, okay, we're going to go ahead and we're going to pull that up. And then from there, you go ahead and you file your tax returns. Okay. Income from flow-through entities taxed once when it flows through to the entities. As Steve Forbes used to say when he was running for president back in 2000, tax once, tax at the source. Okay, that's exactly how he wants it. Tax once, but in this case, it's not tax at the source, it's tax at the end, and all that sort of stuff. And then you have the aggregate approach and entity concepts. And this is kind of sort of seen as the entity approach on that, where it treats tax partnerships as entities separate from their partners. And the aggregate approach treats partnerships as an aggregation of partners' separate interests in the assets and liabilities. So one of the most basic tenets of partnership law is that partnerships don't pay taxes. It reflects the aggregate approach. In other words, the owners are going to pay the taxes, not the entity itself. Now, practically, what happens? So take that same example. You got $100,000 going to you. I also have $150,000 going into you in that example that I gave you. So $250,000 being assigned to the partner. They look at it and they say, okay, out of this, I now owe $50,000 in taxes. Where are they going to get 50 grand? And the answer to that is usually the partnership will do a distribution from partnership to the owners in order for them to pay their taxes. Okay. That's how it practically works. And it should work that way. And if you have and one of the things that I talk about in partnerships, if you're preparing a partnership tax return and you're not looking at the operating statement, you are committing malpractice. And you need to go back and you need to get a hold of that operating agreement. Every time I do a partnership, and I've only done this on one exception, and that's because they were in the middle of redoing their ownership agreement, and so that's why I said, look, this time I'll go ahead and do it. I said I want the old one. They said, well, the old one's being 86. Because we've had a lot of changes in the owners during this time, and so we're revamping the whole thing. The only time I've ever done it, and it was a special circumstance, usually I will not sign a tax return until I've seen the operating agreement, because if you're not, you're committing malpractice. Now, the good news is when they handed me the operating agreement, I didn't see anything that bothered me that required us to do. I did tell them that I said, look, I'll sign it this time, but I want the operating agreement. If we have to do an amended return, you're paying for it. And he said, that's fine. We don't care. We'll do that. And so that actually worked out very well for us. And luckily all this happened in an email. So I had documented evidence in case they try to come back to me with it. And it actually ended up working out. But, so partnerships rather than partners are making most tax elections to the entity. It represents the entity concept. And that's the case. Most of the elections that are going to be made for the business as a whole is going to be done by the tax matters partner. Partners will definitely have a say in it, but and that's why you need an operating agreement. It'll delineate all this stuff out. And so by having all that stuff delineated out, you'll be able to have a good understanding of all that stuff. All right. So that's all I got to do for this video. I just want to say thank you very much. Thank God we're in partnerships. We're back home where I love to be. And I hope you enjoy these video series. And if you have any questions, feel free to reach out to me, and I'll see you in the next video.